I am Peter Joubert from Imali Pro. We specialize in forex trading, intermarket analysis and money flow. The topic for this video is how to develop a powerful trade plan for profits. Many traders trade without a trading plan. If you have a destination in mind where you want to travel to, will you get into your car and start driving without any idea how to get there? Imagine the possible disastrous consequences. If you leave your trading results to chance, the probability is 85% that you will lose your money. 85% of trading accounts are in a loss-making position. One of the first steps to successful trading is to have a good trading plan in place. A trading plan is a framework that guides traders through the entire trading process. It sets conditions under which a trader enters trades, identifies markets, exits trades, and manages risk along the way. The trading plan ensures accountability and keeps traders focused on their personal strategy. You must know what you want to trade. You must do your homework on recurring patterns, how you will trade support and resistance. The trade plan outlines your trading method. When trading, unlike driving, there are no rules other than the ones that we set ourselves. You must write it with the greatest amount of detail, yet keeping it as brief as possible. Readiness for trading. Trading is a business. You must be ready for this business venture before you start trading. You must write your own trading plan, taking into account your personal trading style and goals. Using someone else's plan does not reflect your trading characteristics. Your skills assessment. How ready are you to trade? Have you tested your system with a paper or simulated trading? Backtesting is not always a reliable test of your system's profitability. Some backtesting relies on curve fitting of past events that will not repeat in the same way. Can you do 100 live profitable trades? Mental preparation. Are you mentally and emotionally ready for trading? Read my blog post about trading psychology for all the traps on the way becoming a successful trader. The fact that you are profitable in demo trading is not a guarantee that you will make money with real trading. Start with a small account and adhere to sound money management. Money management. How much trading capital do you have? This is money that you can afford to lose. It must not be money that you need to pay rent or to buy food. How much drawdown of capital will you allow before stop trading? What is the largest drawdown that you're willing to go through before you end your system and retest your strategy? A good idea is to have a maximum drawdown of 10% per month. What will you do with the profits? Will you leave them in your trading account or pay yourself? How to build your trading plan. In a nutshell, your plan must elaborate in detail the whats, the whens, the hows, the whys, and it must include the best case, expected case, and worst case scenarios. A trade plan is not just a combination of a number of indicators. You must have an idea how the markets move and how you will dance with the market. Why do you trade? There must be an underlying reason for your interest to trade the markets. It could be the achievement of financial independence so that you can live a life on your own terms. Many traders get into the game because their primary focus is on money. Keep yourself in the present and don't focus on big goals for future by setting very optimistic targets. If money is your only target, forget about trading success. There are many psychological reasons why you won't succeed. Read my blog post about trading psychology for all the traps on the way to becoming a successful trader. Define your daily routine. Using a daily disciplined trading routine will increase the odds that you will be successful. Your trade plan should outline your daily activities and routine. Define the markets you trade. Identify the markets and trading frames. A good starting place is the markets you are familiar with. Do good research on the markets and take an informed decisions on what you want to trade. How will you analyze the market? We use the market analysis to identify opportunities and trade setups. Technical analysis seeks to predict price movements by examining historical data. mainly price and volume. Technical analysis helps guide traders to what is most likely to happen given past information. Most investors use both technical and fundamental analysis to make decisions. Traders prefer different forms of technical analysis. Day traders may use simple trend lines and volume indicators to make decisions, while swing trading and position traders may prefer chart patterns and technical indicators. Support and resistance zones are something that you must pay serious attention to. Trading is a dance with the market from support to resistance and back in different patterns and steps. Make sure that you are in tune with the market. Some traders apply Elliott waves. Elliott proposed that trends in financial prices result from investors' predominant psychology. He found that swings in mass psychology always showed up in the same recurring fractal patterns or waves. In financial markets, Elliott's theory somehow resembles the Dow theory in that both recognizes stock prices and moves in waves. Because Elliott recognized the fractal nature of markets, he was able to break down and analyze them in much greater detail. You must also consider the opinion that technical analysis does not always work. The fact that 85% of trader accounts are in a loss position is a serious vote of no confidence in technical analysis, which most traders use. Fundamental analysis. Fundamental analysis is a method of analyzing financial markets with the purpose of price forecasting. Forex fundamental analysis focuses on the overall state of the economy and researches various factors including interest rates, employment, GDP, international trade and manufacturing, as well as their relative impact on the value of the national currency they want to trade. There are several economic indicators that financial experts observe because they can provide hints on the health of the economy. These indicators are found in news reports and news outlets. Some are released weekly, most released monthly, and a few quarterly. Intermarket analysis and money flow. This is the process of understanding how the different capital markets influence each other and to follow the flow of money. There are 4 capital markets, namely currency, commodity, bonds, and equities. Read my article, The Key to Forex Trading, for a further explanation. Money flow will give you a good idea of market sentiment towards the different asset classes and currencies. Sentiment moves the market. We get risk-on conditions and risk-off conditions. Risk appetite or aversion determine how different asset classes will move. Some authors and traders will classify intermarket analysis as part of technical analysis. I think it's time to put this approach on its own. Intermarket analysis gained ground in importance over the last 10 years, and some traders are very successful in applying it. A combination of other approaches with intermarket analysis is a sensible method. Once you have identified the trading opportunities, you must use your trading system to determine how you will trade the identified opportunities. Define your trading system. You must have your own trading system. You must learn to trust your edge. The edge means there is a higher probability of winning outcome than a losing outcome. The trading system describes how you will enter and exit trades. Depending on market conditions and instruments, a trader will usually have 2 or more trading systems in a trading plan. Your trading system will determine the time frame that you will use for trading. Many traders use 3 time frames for preparation and entering trades. This will also depend on your way of analyzing the market, as we discussed earlier. The way you find your trading opportunities will also link to your method of analysis. To rely solely on indicators and moving averages is a disastrous approach. Some traders trade with a trend and others counter trend. Some trade congestions, It is a matter of your preference and what is working for you. Don't fall for snake oil salesmen who sell infallible systems that will make them rich and you out of profit. A trading system is something that evolves as you develop as a trader along with market conditions. Number your trade plan and every version change to the plan. Limit changes so that you can check what is working and what is not working. Define your risk. You must know the overall risk as part of your trading capital that you are willing to take. It varies between 2 and 10% of your capital. This depends on your risk profile. If you risk 10% of your capital on each trade, you could wipe your trading account in 10 losing trades. In defining trading positions you're willing to take, you must stack the odds on your side. If you win, it must be 1.5 to 3 times in relation to your stop loss. For example, if you risk $10, your winning amount must at least be $15. In this way, you need only to be successful in 40% of your trades and will still be profitable overall. If you progress to where you can trade a number of lots, you can take partial profits on your way to your target. Avoid setting partial profit based on feel instead of specific rules. Define entries. How and when you will enter the market depend on your method of analysis and trading style. You must know exactly what your different trade setups look like. Some traders are more aggressive and others are more conservative. How will you enter the trade? This can be more complex than it seems, but the more exact you define your entry, the more consistent your results will be. Adding to a position. Some traders pyramid to a trade by adding positions after the initial entry. Define exactly when you will add to your position and when not. Exits. The principle is to let your winners run. There are various ways to set targets. You can use support and resistance levels, the average true range or Fibonacci techniques. Because of fear, some traders exit their trades too early. The set and forget system is applied by some traders. You do your analysis, set the stop loss and profit target, and leave the trade until there is an outcome without interfering. Track your results. Keep a trading journal. You must keep accurate statistics on your trading activities. You can keep live stats on your trading by using MyEFIC books. Make comments on your emotional and psychological state of mind. Trader psychology. A trader must be in a good emotional and calm condition. If you feel upset or in a hurry or cross with the market or anybody else, don't trade. Set yourself a routine to prepare yourself mentally before every trading session. Patient trader waits for the market to unfold to trade an ideal setup. Hurried last-minute instructions from a trading room is usually a recipe for disaster. Trade your own plan that you understand. Your contingency plans will depend on your domestic situation. Your computer and software must be in a good condition. Prepare for power outages. A good idea is to have a continuous power supply in place that will give you at least another hour's connection in case of a power failure. Have a backup telephone connection or another acceptable message device to your broker. In conclusion, a beginner can take years of trial and error to become successful. A better route is to find yourself a mentor that will guide you through the maze to success. But watch out for snake oil salesmen who have never traded in their life. You can use our membership site as part of the mentoring and growth process. Our next video, make sure to subscribe to our YouTube channel. We make difficult concepts understandable so that you can profit. Join our membership site at www.imalipro.com. You can join the free or paid section for invaluable trading information and techniques. In the next video, we will tell you how to analyze and use structures to your advantage in trading.